member of the Finex Trading, the US dollar index, and cotton options as an independent trader. So we're excited to have you with us, Jeff. Let me go ahead.
Can you hear me?
I can hear you. Yeah.
Awesome.
Let me stop my share for you though, so you can share your screen.
All right. So now you should be able to see the title, How to Consistently Grow Your Wealth in Bull and Bear Markets, Trading Only 2 ETFs or Their Options. Does that sound good? Can you guys all hear that, see that? And let me just pull up the questions or responses. Great. Now I can, great. All right. So now, if I don't know, Marissa, if you're going to turn off the questions during the presentation or not, but if you don't, I will. For those of you who want to ask questions during the presentation, feel free. But as you know, we are on a very well-kept schedule here, so I'm hoping that I'll be able to answer most of your questions throughout the presentation as I go, and then at the end we'll have a quick Q&A. So I will look at them. To the extent that I can. I'm not ignoring you if I don't answer them until the end. All right, great. Just a quick question. How many of you here are unfamiliar with Market Gauge? This is the first time you've seen a Market Gauge presentation. I'm just curious from that perspective. And so if you say first time, if it's your first time, or if it's not your first time, then you can say whatever you want to let me know that you've seen us before. Hopefully it'll be something positive, but sometimes I'll get some interesting responses. All right, great. So we've got a lot of new people, which is exciting because I think I'm going to show you something that you've never, I know I'm going to show you something that you've never seen before. But it's not just what I'm showing you. Hopefully it's going to be what I'm going to enabling you to do. So here's a quick feedback that we got from Ari recently. Thanks for thinking of me. He said that because we sent him an email about something completely different, and he just chose to tell us this. I've grown my IRA from under 3K to last fall to 19,000 as of today, which was March. Now that was a volatile period. It was only 6 months, but that's not even the best part of the quote. I can't wait to show you the rest of the quote at the end. All right, because in this webinar, we're going to discover how to grow a small account or a small investment, which is really what I'm going to focus on, into a potentially large sum. But at the same time, at Market Gauge, we're always focused on how to protect what you have. So if you've got a large account and this isn't just fun money and you want to still grow that account, you're in the right place. Ultimately, what I want to show you is how you can outperform the market with a lot less risk. And when I say a lot less risk, I mean smaller drawdowns. And if that doesn't make sense to you, don't worry, we're going to talk about that too. Now, having said that, I know this isn't for everyone, and I know it's 5 o'clock, at least it is on the East Coast. So if this next hour isn't for you, I'm going to give you the next 30 seconds to decide, okay, I can take a break, or really tune in, right? All you have to do is answer yes, and the number of the question. I'm going to ask you 4 questions if this is for you. And then that would be great for me to hear what you're interested in, and it'll also enable you to decide if this is really something you want to tune into. So give me a yes, number 1, if this describes you. You want to control the growth of your wealth with the stock market, but you don't have the time or the desire to spend years figuring out how to analyze the charts and how technical analysis works. Now, if you're already very proficient in charts or technical analysis, I could reframe that and say, you don't want to have to worry about all that. So if that sounds good to you, give me a yes, number 1, and you're in the right place. Now, yes, number 2, and you're in the right place if this describes you. You don't want the stress of managing a lot of positions. All right, so if I use myself as an example, I have the way I'm going to show you right now that I trade. And I also love like getting in and out of stocks. As Marissa said, and you'll learn soon, I came from a floor trader background. I managed money for a hedge fund. I'm very comfortable having 10 to 20 positions on when I'm really focused on the market. But at the same time, I have this secret little set of positions over there on the side that I don't have to worry about. And that is what I'm referring to. And that's what I'm going to share with you. Couple of positions, no stress. So If that sounds good to you, then give me a yes number 2. Now, yes number 3, this is particularly relevant right now because we're going into earnings season. If you don't want the risk of company-specific news hurting your portfolio, yep, that includes earnings, that includes FDA approvals that don't work out, that includes the CEO tweeting something stupid and all of a sudden your stock is, getting crushed today. Meanwhile, the market's doing fine. All right. That goes with managing a lot of positions. But if you don't want to deal with that, give me a yes number 3. All right, great. We've got a lot of interest in that one too. All right. So finally, completely different. If you do want to catch big trend trades, but you don't want the risk of buy and hold, which I refer to as buy and hope, as your strategy. And I'm going to go one step further and say, if you'd like to catch the big trends in the general market, all right? So if you can catch big trends in the general market, you don't have to worry about company risk, and you can catch huge gains, and you're not just buying and holding, all right? So yeah, Michael, yeah, 1, 2, 3, and 4 works fine. And it's hard for me to keep up with the names, but that was a quick one. Yeah, Samuel's 1, 2, 3, and 4. All right. So now, if you couldn't answer yes to any one of those, I won't take any offense. I won't even know that you're taking the next hour off. You can come back for the next one. But what I want you to know that if you said 1, 2, 3, or 4, is you're going to want to spend the next 50 minutes absolutely focused on what I'm about to show you, right? Because I'm going to show you how you can have all 4 of those things. And if you're wondering how all that's possible, well, what if you had an indicator that warns you of market tops and it tells you when it's safe to be in the stock market? That would be pretty timely right now, right? I could actually say that pretty much any time. So when you have a consistent ability to anticipate when the trends of the market are going to be up or down, you can avoid the big bear markets and the losses like we experienced earlier this year. And you can also bank bigger gains by staying in the good trends longer, like we've experienced since the market collapsed. But more importantly, you can have peace of mind. And to me, that's the most important thing, because what frustrates me the most now, and I say now because what I'm about to show you, we've only had for probably the last 5 years. And until then, I and our team at Market Gauge here have been hell-bent on figuring out how to legitimately understand which way the market's going to go and be able to trust it. See, there's a limiting belief out there that you can't time the market. Now, I've never believed that. But it wasn't until we had what I'm about to show you that we could do it without thinking about it. So no longer in our world is there a limiting belief that you can't time the market. Of course, I'm not going to expect you to believe me. Let me show you right up front what I'm talking about. Here's a chart of the SPYs, the S&P 500. And if you don't know what the SPYs is, just say, what's the SPYs? I don't understand or something. But the SPY is an ETF that enables you to trade the direction of the S&P 500 as simply as a stock. Now, what we did is we took the alpha rotation bull and bear signals and colored the SPY green. So SPY means SPY for the S&P 500 ETF. So if the market, if you think of this as the market, is in a bullish mode according to our alpha rotation system, which I'm going to show you, it would be green. If it's in a bearish mode, it would be red. So I'll ask you the question: could you time the market if you knew whether or not this chart was going to be red or green? Now, my argument would be, well, you absolutely could, but it's for your eyes to decide. Now, what we've done is converted that ability to time the market into buy and sell signals. And those buy and sell signals have generated returns that look like this. And in this presentation, I'm going to show you how we created this system. I'm going to show you how we issue these alerts. And essentially, I'm going to show you multiple ways that you can take advantage of anticipating which way the market's going to go. Does that sound good? So again, if that sounds good, you are in the right place. And the charts that you're looking at right here just represent what this has been able to do. So during a time frame where the SPY was up about 89% since 2008. Now that's a couple of months ago. Now it's even higher. All these numbers are larger. So during a time frame since 2008, when the SPY was up 89%, the alpha system was up 574%, right? So more than 5 times what the general market is. And that's just trading the instrument that represents what the SPY is doing. But what I'm going to introduce you to is the SPY 2X. Now, that SPY 2X uses a little bit of leverage, and by using a little bit of leverage, the returns during that same period are 8,700%. Now, that's not using options. That's just using the double leveraged ETF, right? So what does that mean? If you look over on this chart to the right, earlier in the presentation, I said I would talk about a small investment. And what I mean by a small investment is, let's say you started with $5,000. Maybe that's your account size. Maybe you have a bigger account than that, and you just wanted a nibble with $5,000 to start. If you put that in the SPY, it would be worth $9,400 now. If you put it in the Alpha Rotation 2X, it'd be worth $440,000, right? Now, I'm not going to talk much about the SPY 3X because that's a lot of leverage. And I don't want to encourage people to do it, but I want to show you the possibility once you get the hang of the system. The triples turned $5,000 into almost $1 million, right? In the same time that the general market would have turned it into $9,000. Now, if you had done it with $10,000, you can see the results. 10,000 turns to 880, 25,000 turns into 2.2 million. So if you have a large account and you just want to protect it and grow it, let's say you had a $500,000 account, right? And you just wanted to take $25,000 of that, a fraction, and apply this system to it. And from 2008 until now, it turned into 2.2 million. You decide for yourself, but for me, that's taking a small sum and giving your large portfolio a big benefit. All right. Now, I'm harping on this point because at no point here do I want you to hear me say, hey, look, take your whole account and roll it into this thing. Right? You don't have to with this. That's the beauty. It's not going to take you any time to manage, and it will generate outsized returns with a little bit of capital. Now let's look at options. How many of you trade options? Because I don't want to talk anybody into trading options, but if you already trade options, I think you're going to be really excited about this. Now, if you're just thinking about trading options, this is a great way to start because it's very simple. All we're doing is buying calls. Nothing complicated in terms of strategies. And the returns, as you can imagine, are pretty outstanding because the returns on these options are taking the same initial buy signals as those buy signals that you just saw did an amazing job with the underlying. So if you were following our conservative strategy, the option strategy would be up 21,000%. If you were following the aggressive strategy, that strategy would be up 46,000%. So that same $5,000 we were talking about before that turned the SPYs into, or with the SPYs turned into $9,400, with the conservative option strategy turned into over $1 million, and the aggressive into 2.3 million. All right, so one of your questions at the end of the presentation should be really, Jeff, can you really trade with that level of capital? If you want to turn 25,000 into 11 million, we can talk about that later. But suffice it to say, if you only did half of that because you weren't comfortable trading that level of money in options, that's a good problem to have. All right. So this is a question I haven't gotten, but that's a great question, Ed. Ed asks if we can get these returns applied retrospectively. We're still working on that, but I'm pretty sure we're not going to be able to figure that one out. All right, so and that's all the good news, but I'm about to tell you the bad news. But before I tell you the bad news, let me just share this other piece of feedback we've gotten from Jim. Jim has been one of our, I have to say, biggest fans. I think he's referred more people to us than anybody else. And the only reason I say that is I spent hours on the phone with Jim, and he really is an amazing person. When he wrote and said, "I'm a retired investment banker," I had no idea what he really meant. And then I got on the phone with him, and I was I'm awed that he would even say this about us based on his experience. But most importantly, what I like about what he has to say is he's saying it's an indispensable tool. It's my most important resource to tell me when to be in and out of the market, because there's a theme here, right? The theme here is that you can't time the market. And I want to show you that you can time the market if you do what I'm about to show you you can do. But here's the bad news, all right? There aren't any free lunches on Wall Street. This isn't a get-rich-quick scheme. Don't go booking your next vacation or buying your next vacation home because of this. Wait until you can do it, all right? It's not going to focus on quick hit trades, right? It's not like it's going to be one trade and you're rich. And it's absolutely going to require some time and effort on your part. And it requires a commitment to let your profits compound over time, right? Because as I just said, you're not going to make all this money in one big trade. What you're going to do is you're going to know which way the market's going to go, and you're going to take advantage of it. So I'm going to show you how to do this by showing you the 3 secrets that enable you to beat the market by trading the market, which really shouldn't come as a surprise because, as I've already told you, you're not going to worry about individual stocks. I showed you how we time the S&P 500. Now all we have to do is figure out how we're doing it, right? Now, a lot of you are here for the first time, so I'm just going to take 30 seconds to explain where I'm coming from. I'm the one presenting, but Market Gauge has a whole team behind me, and there's 3 partners. And Keith, Michelle, and myself have been helping professional and individual traders since 1997. All 3 of us were floor traders on the futures and options exchange. Keith and I manage money for one of the biggest and most successful hedge funds in New York, Millennium Partners. And that's actually where we started to develop the mechanical type trading systems that I'm about to show you right now. And then as the internet evolved in 1997, for those of you who are old enough to remember that, and Netscape went public, and we realized this was going to change the way we could share information, we branched out to help individual traders. But at the same time, we were pushing our information out on many professional platforms, including Reuters and Bank of America and Fidelity and Bridge, Barron's, Townsend, ILEX, ADP, and more. All right. So we actually come from the professional side. The internet enabled us to get to everybody else. And honestly, it's a lot more fun dealing with everybody else. Now, in order to really understand where we're going to go in this presentation, I want you to understand that there are 2 different ways that you can focus on trading. There's the discretionary way, and there's the mechanical way. One isn't more right than the other, but one is easier when you have it. But most people start with discretionary because there isn't really the ability to find another way to do things. And discretionary, simply put, is when you, as the trader, are figuring out what to do with each trade as the market evolves. Now, many of you, if you just type in your experience in trading, give me, if you would please, I don't like the word give me, if you could just let me know the number of years. So if it's less than 1 year, just put 1. Just give me the number of years that you've been trading. And so I'll speak to the number of years. So if you're starting out, we've got a lot of 1s scrolling up pretty quickly, but I'm seeing 50 could be the highest one that I've seen. So the way I would normally describe this is if you've been trading for 1 year, you're still trying to figure things out. And quite frankly, if you're making any money after 1 year, that's awesome. I don't know if that's good for you long-term or not, but that's great. I would normally say 1 to 3 years is when you try to when you really get your feet wet. And then 3 to 5 years is when you start to really understand what's going on. And after 5 years, who knows? It could ramp up. Now, all of that depends on your experience, but more importantly, we all kind of start with discretionary because trading is easy to get started and very difficult to master. Now, what will often happen is you get either really good at the discretionary or you don't make it. Or you find a systematic way to approach the markets, and that's mechanical. Mechanical, as I'm going to describe it, is you have found a way to apply rules to the market. Now, whether or not you actually have the computer spitting out your rules or you're just very disciplined, you've become very disciplined, you've found your groove, and you've turned that discretionary process into a mechanical approach. How many of you would say, I agree? I already see Dirk saying that's right. Now, what I would like to do for you is accelerate that process and give you a mechanical approach. This is the mechanical approach that I sought after since 1986, when I graduated high school and spent 4 years in college trying to figure it out, and then got lucky and met Keith. I don't have time for that whole story, but I got a lot of agrees, right? So if you're number one, this is a total tangent. Like if you've just started, you're discretionary, trying to figure all this out, and it's frustrating, don't be discouraged. It's part of the process, right? But what you want to do is find a system that's yours. Maybe you adopt it from somebody else. Maybe that's what I'm about to show you. Maybe you'll find it from somebody else. That's why Wealth365 is so great, because you can figure out what works for you. Total tangent, but totally relevant based on all the single digit people I saw. Those of you that, you know, the 36 years, the 15 years, the 50 years, you guys probably know what I'm talking about. All right. So, but that's the setup for why I think it's so important for me to tell you that we're going to talk about how to beat the market by trading the market. And we're going to do it with a mechanical trading approach. Not only that, we're going to do it trading only one instrument and its sidekick, I'll call it. But in order to understand why we're going to do it and what we're going to do, I want to show you the 3 secrets that we've discovered to beating the market with a mechanical trading model. Because in fact, we've used basically these same ingredients for multiple models, right? But this one is specific to the market indexes. And it's specific to the market indexes, as you'll discover, because we are leveraging what I'm going to refer to as the golden relationship that drives all major moves in the stock market. All right. I'm not saying major moves in individual stocks, in the stock market. And the second thing we're going to look at is what to avoid, which I refer to as the Achilles heel of buy and hold investing, the Achilles heel of trading systems, which is what we're about to talk to, and absolutely the Achilles heel of discretionary traders. And finally, we're going to talk about how you leverage the most powerful profit multiplier in trading and investing. And that will also apply to buy and hold trading systems and discretionary trading. Who knows what that is? Throw it in the questions, or throw it in the questions box. I'm not going to respond to it. I just want to see how many of you get it right. So let's start with number 1, the golden relationship that drives all moves in the stock market. And this could not be more true right now. The most powerful force in stocks is the balance between what investors are willing to pay for assets that are going to grow versus assets that are going to provide yield or income. All right. I don't have time for this tangent, but ever since March, all I have heard from so many people who I have so much respect for has been, I don't understand why this market keeps going up. And I keep telling them it's simple. All right. It's really this simple. And you have to understand that what the big money is looking at is, where should I put my money in things that are going to grow or things that are going to provide yield or income. All right. Now, growth assets are more risky and they offer higher returns. Yield assets are less risky, but they offer lower returns. Now, stocks represent the growth and the risk, and bonds represent safety and income or yield. Now, a lot of this, most of you probably are saying, I've already heard this, right? But the secret to determining which way the market's going to go lies in knowing what the market is more interested in, the risk on and betting on growth, or the risk off and betting on assets or yield. All right. So I don't have time right now, but if we have time at the end, we can apply this specifically to what's going on in the market right now and why the market collapsed and why it came back so ferociously and why it's going to continue to go higher. All right. So we've developed a way to measure and see the bigger trend of what investors really feel in terms of risk on or risk off sentiment. And if you want to know what the big investors' appetite for stocks are, you need to look at what they're doing. Now, the reason this is so important is because, and the reason I keep saying big investors is because, no offense to any of you, but what you and I are doing, buying and selling, isn't what's driving the market. And I know the Robinhood thing is all the craze right now, but still, that is not what's driving the market, right? It may be driving some stocks, it may be good media, but that's not what's driving the market. What's really driving the market is the biggest investors and whether or not they have an appetite for risk or risk off. Now, we can sum that all up by saying, imagine if you were able to know whether or not these big investors are bullish or bearish on conditions such as economic growth, corporate profits, inflation, interest rates, geopolitical risk. This is what drives the big and the smart money, right? Now, we boiled this all down to some really simple gauges. Gauges that when they're red, it means the big money is bearish. When they're green, yellow, it means they're neutral. When it's green, it means they're bullish. Remember that chart I showed you just a little bit ago? That was a little bit more sophisticated than this. This was taking this analysis, putting it on that chart. So if you thought that chart was pretty good at figuring out which way the market was going, here's how we did it. Sound good? Interested? So I've referred to it as the alpha rotation model. That's the name for this model. And a model just means we're taking a bunch of inputs. And from those inputs, we're determining whether we're determining an output. And in this case, the output is whether we should be bullish or bearish. And so those 5 relationships all measure what big investors' expectations are about this golden relationship, risk versus yield. Now, one of the earliest, like tried and true measures of expectations of growth versus income is the relationship between utility stocks and S&P 500. Now, the reason for this is if you think about it, if you're a stock person and you want to figure out whether or not stock people want to buy stocks or they want to buy yield, then why not look at the utility stocks, which have always represented safety and yield, versus the S&P 500, which includes a whole bunch of growth names, and figure out whether or not the market wants more of the safe stuff, the utilities, or the S&P 500. Now, the fact of the matter is, when I was on the floor in 1990, even before I got to the floor, I knew about this relationship and it worked, but I didn't know how to convert it to this. So we took the relationship between how is the S&P 500 performing relative to the utilities performing, converted it to an indicator, and that indicator turns bullish and bearish based on which one is performing better. And then we took that bullish and bearish and applied it to the SPY chart. So this is the S&P 500. Imagine you were long this chart every time it was green, and you were out every time it was red. How would that work for you? I can tell you that if you do the numbers, it's going to work really well. So Dan saying, what about colorblind people, green and red? I don't know if you're serious about that. I can tell you that you won't have to worry about that with what I'm going to show you ultimately, because we're going to turn it into buy and sell. So that's all I can say about that. So this is the S&P 500 versus the utilities. If you look at that relationship, it gives you a really good idea of what the market's going to do. But we took it one step further than that. Another way to look at growth versus yield would be to look at the S&P 500 again, which represents growth. Those are stocks, and treasury bonds. Treasury bonds, right, are the safest yield you can get. Same idea. Which one are big investors going after? And if they're going after growth, it's green. If they're going after yield, it's red. Again, just look at the big down moves, and it keeps you out of every major down move. Look at the big up moves, and you'll see it's not uninterrupted by some periods of caution, and it's not perfect, but it keeps you in the major moves. And more importantly, as you're going to see, if you can avoid the huge down moves when you're a swing trader or an investor, you will come out way ahead. And this does it. But then we took it one step further. Rather than just look at yields, why don't we look at how risky yields are? So we look at high yield debt versus treasuries. Now, the reason high yield debt is so powerful is because high yield debt is the first thing in the fixed income market to get absolutely crushed, and you'll get hurt even harder in high yield debt than you will in any other debt. So when smart money is buying high yield debt, they're bullish. They're not just bullish about debt, they're bullish about growth, they're bullish about stocks. And therefore, looking at high yield debt is one of the best leading indicators for stocks. A lot of people already know that, but what most people don't know, or what you won't hear, is looking at high yield debt relative to what bonds are doing, or treasury bonds are doing, is an incredible indicator for the stock market. Think about it. We're looking at two fixed income instruments, two ETFs that measure bonds, and we're putting that indicator on top of stocks, and look how well it does. There's no stock in that indicator. It's all bonds. All right. As you know, we're not stopping there. We have 5 different indicators. So the next indicator we look at is gold. Gold versus growth. Now, why do we look at gold? Quite frankly, gold frustrates me as an asset class. But the reason probably is because gold represents an asset class that big money runs to for many different reasons. But at the end of the day, investors never run to gold because they think things are great, right? They're going to run to gold because there's either instability in currencies, there's instability in political situation, there's instability or negative situations in terms of inflation, right? There's fear that eventually whatever we're doing is going to lead to inflation. Now, gold and stocks can rally at the same time. That's true. But if gold is going up faster than stocks, you want to be cautious. All right. Again, we look at the relationship between gold and stocks. We put the bullish and bearish indicator on stocks. You tell me. I'm not here. I'm not going to tell you that this just works. You can see for yourself how well this works. You want to be long when there's green, and you want to be out when it's red. Would you agree? And if you don't agree, argue now, because here's where we see the charts. And Kyle, you're absolutely right. But wait, there's more, right? Now I'm going to take it to a whole different level, and I promise you this is the 5th one. But I promised you in the beginning. And so, yeah, Joseph's saying these all look the same. They do all look the same. You know why they look the same? Because all of these indicators do an amazing job at telling you when you should be long stocks and when you should not. So here's wood versus gold. Now, this is a relationship most people would never think of. But again, wood represents growth and optimism in the economy, and gold represents fear or inflation. So it's an outstanding measure of where the smart money is going to run. So if we add all those up, 5 different indicators that measure growth versus yield, it will tell you what the bullish or risk on and risk off environment for stocks is. And remember, these are not based on what they're saying on TV. This is based on what the markets are bearing, what they're buying. So we take all those, we convert it to this gauge. And I'm going to come back to that in a second. So I spent an inordinate amount of time in showing you the guts of how this works. So I am going to now have to accelerate secret number 2. So secret number 2 is drawdowns. You don't want drawdowns. Avoiding drawdowns is the most powerful characteristic of any good system. What do I mean by a drawdown? It means that when the value of your portfolio is going down, it's a drawdown. Now, even if you don't take a loss, the decline in your account's value represents a lost opportunity. You could have bought lower. It's emotionally stressful, wouldn't you agree? And we've had 250% declines since 2000, and then that doesn't include the 40% decline that we had recently. And if we look at NASDAQ, we can see that from 2000, it went down 78%, never got back to new highs, and then still lost half its value. So it took 17 years to make that one up. Now, alpha, what I'm about to show you is you don't have to worry about 56% declines. I'm not even talking about the 78% declines. Alpha rotation with no leverage, just like the SPYs, biggest drawdown is 12%, which means that if you started with $1,000 and lost 56%, you'd have $440. Now, I don't know about you, but that would not sit well with me. More importantly, as the math works out, that means you have to make 127% in order to get your money back. This is where drawdowns kill you. With alpha rotation or any other approach to investing where you don't take big drawdowns, a 12% decline, you only need to make 14% to get your money back. Now, I don't know about you, but banking on 127% decline versus 127% gain versus 14% doesn't seem like it takes a lot of brains to figure that one out. And so this is why alpha is able to do what I described earlier. We absolutely crush it. This chart represents if you had put X dollars, $1, $10,000 into alpha, you'd be in 2008, you'd be on the red line. If you put $1, $10,000 into the SPYs, you'd be on the blue line. That pretty much says it all, right? There's no leverage there. Now, here's where it gets really interesting. All right. Alpha rotation works because the risk on, risk off gauges measure when to be in the big moves. But we don't buy and hold, right? We don't suffer those big drawdowns. That said, we still make money in drawdowns. All right. And we use what we call profit multipliers. So with no leverage, alpha rotation could just trade the SPYs. We have an initial stop of 6%. I'm telling you that because you're probably wondering, what's my risk? And the reason we do that is because it provides that certainty. Now, the largest winning trade with no leverage is 18%. The largest losing trade is we get stopped out at 6%. The average winning trade is 4%. The average losing trade is 1.9%. Now, that means that our average win is twice as big as our average loss. And some of you might be saying, well, that doesn't sound that impressive. But if you combine that with 69% winners, right? And then you make money during the red periods. Not all the red periods, but we don't just trade the SPYs, we also trade the bonds. And very often the bonds will make money during those red periods. And that enables us to make money in good markets and bad. But where it really kicks in, when you're that consistent, you can have leverage. I talked about this in the beginning of the year, the 2x and the 3x. So that 500% gain, when you have leverage, now turns into, in this case, 8,600% gain. All right, here's the SPYs down here. This is the same equity curve, but with 2x, with some leverage, you totally blow the market out of the water. All right. Now, let's talk about secret number 3. Secret number 3 is the most powerful profit multiplier. Who knows what this is? 3, 2, 1. I know there's a delay, so that's not fair. Dirk has it. The Fed. Yeah, well, the Fed, that probably is true, but it's not really the multiplier. It's not options, which is the most popular answer. In this case, it's simply compounding. Now, I'm going to show you this chart really quickly because I know that it's just very hard to comprehend how if you had the alpha rotation 2x returns, notice these are the returns every year since 2008 through 2019. So I could get a full year in. 2020 are off the charts. I think we're already pretty close to 2019 returns. And as you all know, we're halfway through the year. So what I want to point out is that I'm not promising you're going to make triple digit returns in any one year. But if you compound, if you just let your profits ride, $10,000 turns into $573,000, which right now, as I told you earlier, is $800,000. All right. And this is how it happens. All right. If you want this spreadsheet, send me an email. I'll send you an email. The thing that really represents is that if you had started with $10,000 and said, I don't want to risk more than $2,000, you never would have been stopped out and you could have just let your profits grow to $573,000. Now, it gets even more exciting, but again, I don't want to tempt people to become options traders if you're not options traders. If instead of doing this with ETFs, you do it with option strategies. And we have 2 option strategies. Both of them are very straightforward. All we're doing is buying calls. We're buying a call and we're selling it at a target. That's it. It's really straightforward. If you trade the ETFs, we're in the ETFs longer. We scale out, but with options, it's hit and run. All right. You're in and you're out. Now it's not quick hit, but it's not complicated. Now we have conservative and we have aggressive. To make this really straightforward, conservative means that we're using higher delta, so it's less volatility. All right. If you don't trade options and this is over your head, stick with me for 3 minutes. We'll be done with the options. Conservative is high delta. Our average win is 57%. Our average loss is 18%, and we have 61% winners. And with that, we get a 21% return. Now, the aggressive strategy, we use a lower delta, so it's a more volatile option. But as a result, our average win is 134%. Our average loss is 34%. So quite frankly, if you're not comfortable losing 50% on your option position, don't trade the aggressive, because that's going to happen. Why would you do that? Well, because your average win is 134%. So we know how averages work, right? You're going to win 56% of the time. Your returns are 46,000%. So if you like going for the big win, aggressive. If you like going for smaller wins and smaller losses, conservative. So I come back to, here's Jim again saying, for those who want to manage their money with higher returns, more confidence in what they're doing, find Market Gauge an indispensable tool. So what I presented you is an opportunity now to either focus on options or ETFs. I don't want to convince you to trade options by the percentages, because quite frankly, if you could make 8,000 or more percent just trading ETFs, that should be enough to get you started. Now, the best part about this is you can do this with only a few minutes a week. Now, the reason is because we use end of day data. We don't look at the markets intraday and worry about what they're doing, except for whether they hit stops. All right. All the trade adjustments that we do, we will let you know via text or email at the end of the day. And if it's a new position, we get in the next morning on the open. All right. So you don't need to watch the markets all during the day. You'll know your stops for your exits and your targets as soon as you get into the trade. So again, you don't need to watch the markets during the day. And we've got a model portfolio that tracks everything for you. And what does a text alert looks like? It's really simple. Alpha Rotation has a new alert. Go check out the details on the website. The website will have an open position, and the open positions will tell you what your entry date is, your entry price, how many shares you should buy for every $5,000 you're investing in the system, where the stop is, where the target is. You'll know everything. In addition, you'll know what the gauges are saying, right? If you're trading options, you're going to have the same thing. 100% done for you option trades. We'll tell you the strike. We'll tell you the contract. We'll tell you when to enter, when to exit. It'll all be laid out in your model portfolio, all right? And it's with those trades that we've generated these returns that I showed you in the beginning of the presentation. So can you see how in the beginning of this, I could tell you that you could take control of the growth of your wealth without having to figure out how to analyze charts? We're not looking at charts, right? The model has figured out, based on what big investors are doing, when to be in and when to be out. You don't need to manage a lot of positions because you're only trading the SPYs or the TLTs. Now, if you trade the options, you'll have the options will enable you to trade Qs, SPYs, and IWMs as well. But that's it, all right? And you're not taking any company-specific risk because we're trading the general market. And we're trading the general market for big trends. We're not in and out in one day. Average positions are probably between 30 and 60 days. So what's the secret to all this? Well, no big drawdowns, smaller losses, ride the trends longer, and be consistent. It's that simple, right? Now, if you were to just go by Alpha Rotation, it would normally be $19.97. If you were to buy the options version of it, it would normally be $24.97. In addition, you'll get a bonus of Big View, which I'm going to come back to in the Q&A session. Basically, Big View, $197 a month, enables you to, in a discretionary way, figure out which way the market's going and get the gauges as a indicator on the chart, plus a weekly video by Keith that tells you exactly what to look at. So that's a total value of $4,300 and $4,361 per year. But as Kyle said, wait, there is more. And all joking aside, what I've shown you is a mechanical trading system. And it's a mechanical trading system that is based on indicators and an approach to the markets that you really won't find anywhere else. And we at Market Gauge have several mechanical trading systems, and we don't really believe that you should just trade a system and not know what the hell it's doing. All right. So we spend every month an hour to 2 hours in a live session mentoring you on mechanical trading systems. And we look at what the markets are doing relative to the system. We look at what the system's doing, and we cover multiple systems. So if you become a member of the Alpha Rotation system, you're also going to see what's going on in other systems. Now, honestly, you're not going to see enough of what's going on to know all the buy and sell signals, but you'll see how it's doing and why it's doing it. And we do this because we want Market Gauge and Alpha Rotation to be your gateway to becoming that mechanical trader that most people never get exposure to. But you're not going to spend $19.97 a year on the ETF version. You're not going to spend $2,400 a year on the options version. And you'll get the bonus of Big View Premium, and you'll get the live monthly coaching. You'll get $6,700 worth of value. And because you're here at Wealth365, if you use this special URL, marketgauge.com/alpha365, you choose trade the SPYs, and you have the full year for $9.97. Trade the options, and you'll have options on the SPYs, Qs, and IWMs. Now, the reason you get all three markets with the options is because in the SPYs, with the ETF, we scale out. You've got more trades there. You're going to be in it longer. With options, you just take the first part of the trade. And as a result, you would have less trades if we didn't include all the markets. Now, in both cases, you're going to go to the page, marketgauge.com/alpha365. You're going to see these same buttons that you see here. And if you click on them, you'll get to the order form and you'll be able to see that there is a special upgrade to a lifetime version. So if we've set it up so that you've got the absolute lowest price that we offer anywhere right now, because Wealth365 does such a great job for everyone, for us as traders, for you as participants. And so you've got the best deal you can possibly get here. Use that link while it is still available. If you have any questions, just give Rob a call. He's our product specialist, or give him a text. That's his cell phone number, 407-770-7637. If it's really late, text, don't call, because he answers at all hours of the night. He will get back to you. All right. So either way, you can click on that to see an opportunity to get a lifetime offer as well. Now, you're also protected by our 100% performance guarantee, which means you want to start for a year, see if it works. Go ahead. If it doesn't make money for you, any one of the models, doesn't matter, right? Any one of the models, let us know. You get the second year for free. Now, I talked about earlier that you could have a big account or a small amount. And I'm going to, Carlton here wrote into us and said, oh, I love the alpha rotation program. I'm up roughly 400,000 in my 401k since January 2020. Now, I want to make sure that I'm just completely transparent here. As you all know, we had a pretty volatile beginning of the year, right? But here's how alpha did, right? So notice how alpha was bearish as we were moving higher. This is when Carlton was in it, right? The thing is that when this was red, we were long the bonds. So we were actually making money on the upside. And when it collapsed, made money on the downside. And then when it bounced, made money on the upside. You want to know what that looks like? Here's the top of the market. Now, I know I'm running out of time, so I can't go through each trade, but you can see the trades in February, March, late March. We are banking profits in the bonds as the stocks are collapsing. All right. Now, if you were in the options, you weren't banking the 100% gains we were getting in the TMFs. It was a 300% gain. All right. So we nailed the top. We've done it consistently. And now you can too. All you have to do is go to marketgauge.com/alpha365. You do have to do it now because, as I said, this is the lowest price. You won't find this price on our website. And if you have any questions, give Rob a call or text him. Or on that website, you'll see there's live chat. All right. So I know, Marissa, you want us to wrap up now. If there are any questions, you can also feel free to give us just run to that URL, grab Mary in chat, give Rob a call, and we'd be happy to help you. I thought I'd have 5 minutes for Q&A, but I want to be sensitive to the time because these guys are great about keeping everybody on time, and I want to respect it. All right, Kyle, it's been a pleasure listening to all your comments throughout the presentation, and everyone else who's chimed in. No Q's, no A's. Like I said, I do watch them, but I'm also watching the clock, and thank you very much.
All right, Jeff, thank you so much for that. And that link is in the chat box, so make sure everybody takes advantage of Jeff's very special offer there. So appreciate you being with us, Jeff.
Can I suggest can I say one last thing?
Yeah.
Please, I'll say this for me and for all the other presenters, please do take advantage of the feedback that Wealth365, that poll. I didn't know you guys were doing that. And I saw that in the previous presenters, please, for all you listening, go fill out, give us your feedback, because we all do want to know how you guys like what we're presenting.
Yeah, definitely. I mean, it's very helpful for us and it's helpful for the speakers. So I'll go ahead and take the screen and actually throw up that page right now for everybody. But thanks again, Jeff.
Oh, do I have to release it to you?
Oh no, I'll take it. I'm
All right.
taking it right now. So
I'm
thank
used to
you.
that.
It's okay. I got it. All right. Hopefully I won't have any technical issues. I've been having so many this afternoon. So let's make sure that, we get through this unscathed here. Okay, so again, this feedback form, which Jeff mentioned and I'm showing right now, is summit.wealth365.com/feedback. Let us know your thoughts on all of our presenters, good, bad, indifferent. It really does help us. As we plan our, like as I've been saying, as we plan our future events. But yeah, your feedback really does count, and is a big part of who we do include going forward. So again, summit.wealth365.com/feedback, and then. All right. Wealth Charts. Are you a member? Get signed up right now, wealthcharts.com, and you can get in for that $67 a month rate. It's a very low price. We jam pack as much as we possibly can into your membership because you're getting all of the charting, you're getting the real-time data. Everything's HTML5, so you can use it anytime, anywhere, phone, tablet, computer, whatever you want. Basically, you can just open up your internet browser and it's there for you. Everything is customizable on the platform. You'll get the summit recordings as well. So those the ones from this week, that the July event, and then also all the past ones. So we have like 2.5 years of summit recordings for you there. For you to access, as well as other really great content from Rob and Hubert, Tony Zhang. So you definitely want to check that out. It's like tens of thousands of dollars worth of course material even that we include. So I mean, that alone in and of itself is worth the very small price that we have this membership at. So get in now while you can as a founder member for $67. If you click that sign up today button right there, that'll take you to the page where you can fill out your info, very easy to do, and then you'll be, good to go there with your Wealth Charts membership. And then you'll also want to make sure that you join Rob later on tonight. He's going to be on after our last presenter of the day, which is Dan Passarelli. So at 8 p.m. Eastern, Rob will be back to answer all of your questions, also do some strategy sessions. So even if you're not a Wealth Charts member, you can still come and ask him some really great questions there, and he'll share some strategies with you, like I said. So you won't want to miss that. He's been taking a couple hours every night to like stick around. So I don't know how he's doing it energy wise, but but he's superhuman, and he really likes doing this for you. And I don't really know a lot of other CEOs that would do something like this. So it's really cool that Rob is really making himself available for you there. And so with that being said, go ahead and get signed up right now for Wealth Charts, wealthcharts.com, and you can click that sign up today button. All right, let me go ahead and get to the prizes here. So we had the Todd Horowitz